let's start with a brief introduction of where we are headed. You know, we all talk about, currently we are a 3.5 trillion economy. In 7 years, by 2030, we should be about a 7 trillion economy. 4 years after that, we should be a 10 trillion economy. But getting there is really difficult. So the first thing that needs to be done for the sustained growth of 10% on, China has done it in the past, but very, very few countries have done it. So one of the key critical aspects of getting a growth, getting to the point of a semi-developed, a higher middle income economy, per capita income economy, is access to finance. So this will be very, very critical in moving. And remember that this is a huge scope. There's a huge spread of various financial services in the system. Start from the big infrastructure projects. The green finance projects, it is estimated that by 2070, India has a very, very ambitious target, net zero carbon target by 2070. People have estimated that India will need $100 trillion, $100 trillion by 2070. Our infrastructure projects, we are still way less penetrated in terms of infrastructure, despite whatever you see happening in Mumbai. If we need to improve our exports will be a large driver. You will need to improve your logistics, infrastructure, etc. That's a huge amount of money. If you want to grow sustainably at 10%, nominal 10%, your attention, your focus on the MSME sector will need to be absolutely laser focused. Because not only that, MSMEs are a very large source of employment, which, as all of you know, is a big problem now that India is facing. And this is where the role of the BFSI sector comes in. Because this is not just financing this kind of growth, capex, etc. It is also a huge source of employment. I think it's more than the IT sector, but it's one of the top 2 or 3 sources of employment in the country. So right now, the way that the Jan Dhan Yojana, the other programs, the JAM Trinity Jan Dhan Yojana, mobiles, Aadhaar cards, the old problem of banking the unbanked is more or less done. I mean, people are more or less banked. I mean, there's some pockets lying around. Right now, the problem is funding the unfunded. And that's essentially the micro and the small segments of the economy, which is where all of you come in. Because this is something that your focus, your technology is enabling this more and more going forward. The biggest change that has happened in the BFSI sector, and this is related to economics, is that the old models now, with the tech companies now leading the charge, economics used to be dominated by something called the diminishing returns to scale. So as you grow, larger and larger, the amount you contribute diminishes, the marginal return from scale. Right now, it's become completely the opposite round. Right now, the bigger companies, and with network economics, etc., the bigger companies are growing bigger. You can see that in the tech space, yeah, the Amazons, the Googles, the Microsofts, the Apples, etc., whatever the enveloping technologies. So this is now a very major problem for both regulators as well as for competition agencies. Because unfortunately, this just means that more and more the larger companies will become larger, and more monopolistic tendencies, oligopolistic tendencies will begin to come in play. So this diminishes competition, which is not good. Competition is a must for new innovation, etc. So this is what a lot of regulators are now focused on. Yeah, that, I mean, you know, how to break up these large tech companies. And remember, these tech companies are now the foundations for the banking sector as well, BFSI sector, insurance, banking. So the large banks in the world, the Capital Ones, the JPMs, the Royal Bank of Canada, I mean, all of that. So these guys are beginning to become larger and larger. Regulatory compliance has become a huge problem. So all of you will be facing the regulators at some point in time. So regulators have a peculiar problem. I mean, they have to tread that line between allowing innovation and not allowing systemic risks to build up. We've got enough evidence of that in the last year or so. The biggest one that you saw, you have heard of, is the Silicon Valley Bank. So that was a stupid problem, but that just showed how how risks can fall through the cracks of the regulatory system. They should have spotted it much, much earlier. The kind of concentrated risks that, and even in India, homegrown, there have been many, many instances where regulatory oversight, if not failed, failed to detect sufficiently in advance. So regulators are not going to be, they are not going to spare any. So regulators are going to come down like a ton of bricks. And particularly now, with these new technologies that are coming in, data protection, data privacy, etc., KYC, they are very, very worried about this. You've seen a whole host of regulatory actions now coming in. Regulators, typically the approach has also changed. I mean, typically you used to have large penalties, 4 crores, 5 crores, but now they will just shut down the business. So this is the regulatory part, which is, in this, legal frameworks are also very important. I mean, you have to ensure a level playing field, given this fact that we are talking about in terms of the big becoming bigger. So you have to ensure that no barriers to entry are put in place, that people can come in, move into the system, innovate, etc., so that the legal systems are going to be very, very careful. Security and data safety. This is something which is absolutely top of mind. So again and again, and this is a global phenomenon. This is not just India, this is not just RBI, SEBI. So data safety is a big problem, and particularly with India's digital public infrastructure, which is a huge boon, by the way, which is a huge boon for the banking and financial services sector. This is going to be a big problem, and regulators are going to absolutely make sure that you don't, absolutely zero incidents of data leakages, etc. If not, there will be penalties put in place. So again, coming back to the old ESG systems. So all three alphabets are important, E, S, G, but way beyond anything is the E part. And this is something that all of you would have seen, the consequences of the current heat waves that are now put in place. So this is something which data, and now, because the loss of productivity coming in from the disruptions in climate, is terrible. So if it can easily shave off 2-3% out of the 10% growth that we are targeting, the sustained 10% growth that we are targeting, easily shave off. So now more and more innovative insurance products are being put in place. I don't know whether you've heard of this, that with this organization based out of Ahmedabad, Seva. So now insurance companies have products which look at the temperature. So if the temperature grows up, say, beyond 45, people in the Seva segment, the women's self-help group, they get paid 450. If it goes beyond 48, the payouts increase. And these premiums are paid by Seva, by other institutes, etc. So these insurance companies will now have to play a big role. ESG companies will need to work very closely with to prevent greenwashing others, because there's an enormous amount of funds lying around in the global system, funds out of Norway, funds out of Canada, etc., which is looking to invest in green projects, but they need to have a sustained confidence that those projects actually bring down the carbon content. Sustainalytics. Axis Bank, by the way, had floated the first green bond out of the London Stock Exchange in about 2017, if I remember correctly. So these things will become more and more important as we go along. So now, this is the broad top-line growth, that the contours of the BFSI sector that you will probably see going forward. What do the individual specific institutions need to do in order to be able to tap some of these developments, some of the risks, etc.? So again, I mean, it goes without saying that all financial institutions have to evolve. There is no doubt about that. So there are some key levers that financial institutions have to worry about. One part is, what is the kind of business that financial institutions, FIs, need to target? Are you going to be a universal service provider? Some banks obviously would be. Some insurance companies would be universal service providers with everything. But then the other parts, which is where Vymo is excelling, is where what are the specialized handles that need to be done in order to be able to integrate various segments that are disparate segments which don't talk to each other. Yeah? So now, again, I mean, a whole host of these new technologies are coming in. Digital banking, all of you know. RBI is still not very comfortable with digital banking. It had put out a circular in 2022, but not very keen on pure play digital banks. Although across the ASEAN economies, particularly the Philippines, pure digital banking licenses are being encouraged. Yeah, so I mean, this is something that will come about. Pure digital banking play, no branches, no nothing. So pure digital banking systems. Open banking. This is something which is very, very important. Right now, I mean, coming in from my former organization, we have about 500 odd APIs. So this is the new form where this gives the client, the customer, the power to actually customize the products. So previously you had these large enterprise systems, SAP or whatever, I mean, Oracle, SAP, the large enterprise systems. Those are now beginning to come back a little bit, shift back a little bit. These APIs give you the power to design, to customize what you want from the banks. Open banking. You can develop the APIs in order to link the interface with the banks. So corporate payments, corporate collections, UPI payments, whatever. I mean, it's a whole bunch of working with the government, the GM platforms of the government. So all of these now coming in, and particularly again in the MSME space, the little parts that come in. So this is one fact, this is one feature of the BFSI system. The interfaces is going to be very, very important. Customer retention has become a big problem. Customer retention is something that, I mean, customers are very mobile now. I mean, they will shift whatever from one institution, intermediary to another. They're not going to be able to stick. For getting the customer to stick, to getting the stickiness of the customer, banks, intermediaries, etc., will need to provide them more and more products, hooks that will keep them within the own intermediary, the banking sector. There's a large payment bank, BNY Mellon from New York. They had done a report, they had done a study that a minimum of 5 products, financial products, is needed to get a retention rate of something like 30 to 40% of customers. This is going to be a big problem. How do you offer more and more products to customers in the journey of the customer, in the business journey, the personal journey, etc.? How do you offer more and more of these? Employee retention is, again, another very big problem. You can see the attrition rates in banks now. So employee retention, talent in banks is going to be a very, very major problem. So finally, I'm coming in now to the end. So one part now is, one of the things is more and more digital currencies are coming into play. Multiple pilots are being run, both wholesale digital, these are these CBDCs that you hear about. CBDCs have a purpose. So CBDCs, one with the rise of the cryptocurrencies, bitcoins, that wasn't too big of a deal with the central bankers. They didn't like it. But given the fact, the kind of volatility that entailed in the cryptocurrencies, they were not too worried because, I mean, there's no way they could serve as an alternative means, as an alternative currency, because there's no store of value in that. But with the emergence of the so-called stable coins, yeah, a meta stable coin, so whatever, that got their attention. That made them sit up and explore the use of digital currencies, CBDCs. This is very, very important. The big use case of CBDCs is cross-border transfers. Cross-border payments has been one of the most inefficient forms of payments. I mean, 2-3 days with the SWIFT system, etc. At the end of the day, you didn't know whether that amount has been credited, debited, or whatever. So this is going to be a very big use case. But together with that, you also have another use case coming up, which is the subsidies and the financial inclusion. Financial inclusion, remember, is one of the big aspects of getting down to the absolute bottom rungs. One of the key features of a central bank currency, digital currency, e-rupee, that all of you have heard, is the ability to program. The programmability of the central bank digital currency is a very powerful tool. People ask me, how is a central bank different from the UPI transactions, etc.? The key difference is programmability. You can program, you can absolutely target the last mile. If you need to give money for a fertilizer subsidy, you can make sure that that currency is spent only at a fertilizer outlet, nowhere else. So this has become a very, very powerful tool with the currency. So again, stronger reforms. You can see with this flood of data now. Can you imagine, what are the potential for that all of you can do with the kind of data that the digital public infrastructure in India is about to throw up? One is the GSTN data. That goes without saying, because now you can get virtual real-time information on economic activity almost at a street level, if not at a pin code level. So that is going to be a very, very important part. So this data will enable a huge amount of potential in the system, but it also opens up a huge amount of risks. So again, finishing, the key takeaways from this, one part which we started from, the world is going to be an even more uncertain place. It's already very uncertain. Business cycles have become much shorter. Rather than the big business cycles, they're up and down, the amplitudes will increase. So geopolitical fault lines, technology changes, becoming extremely difficult to predict what the future is. One has to be very, very agile. The competitive landscape will be defined by large institutions. Because that's the nature of economics in the system now, who will have increasing control on data, which is something that all competition regulators, all financial sector regulators are worried about. The European, the DG4, European anti-competitive regulation, is one of the fastest, one of the most proactive in this. Financial and competition regulators will have to maintain that level playing field that we talked about. Stringent data privacy and data protection laws must to establish the integrity of the financial system. The financial systems are based on integrity. If people lose faith in the financial sector, it entails a huge loss of investment potential. Retention of customers and employee talent, we talked about this. Last, climate change. I cannot emphasize this again and again. The kind of risks that climate change is now providing, is now throwing up. And this is going to be a major problem. So we need to shift. One of the large players is already committed to about spending $100 billion over the next 10 years in greening projects. So the effects of climate change and the opportunities that are available, I have no doubt in my mind that the next cycle, private sector investment cycle, is going to come in from the E part of the ESG part, the environment part and climate change. So this is basically what the overall contours of the system are. I'll stop here. Thank you once again, Vymo, for giving me this opportunity. Wonderful to be able to come in here and interact with all of you. Thank you very much.